For those of you who haven't been able to pick it up, we have copies of our press release available on the outside if you would like to get one on the way out. And we released our results this morning. Can I introduce the panel of representatives of the different SM Group companies here on the podium? Starting on the left-hand side, we have Mr. Joey Mendoza, the president of SM Supermarkets. Next to him, Mr. Giorgio Mendiola, president of SM Retail Inc. Mr. Jeffrey Lim, the EVP of SM Prime. Mr. Jose Sho, EVP and Chief Financial Officer of SMIC. Mr. Harley C., the president of SMIC. Richard Tan, first vice president for investor relations and corporate planning at BDO. And Mr. Alex Escucha, first vice president for corporate planning at China Bank. You'll have the opportunity to ask questions directly to the panel in a little while. In the meantime, to present our results for the half year, I'd like to invite Franklin Gomez, Senior Vice President in Finance, to walk us through the numbers, please.
Thank you and good afternoon. The group consolidated revenues increased 7.2% on a headline basis to 130.9 billion for the first half. On an underlying basis, however, the increase was 9.7%, and the difference was due to extraordinary gains in the first half last year, largely from the trading gains of the banks. The first half net income was down 3.1% on a headline basis to 12.3 billion, similarly impacted by the strong first half numbers in 2013 that included 2 billion of extraordinary gains, without which the underlying net income was up 11.8% compared to the first half last year. This represents solid growth in both revenues and net income in our core businesses. In terms of group earnings composition, the property accounted for 40.5% of consolidated earnings, and the banks 39.8%, and retail 20%. On an underlying basis, the group net margin improved 20 basis points from 9% to 9.2%. And the group balance sheet also remains strong with total assets growth of 6%, and the ratio of net debt to equity was very healthy at 40 to 60. Looking at our results by each of our core businesses, in retail, sales growth was good in the first half, up 9.1% compared to the first half last year. This includes same-store sales growth of 4.4%, which was positive across all formats, both food and non-food. However, net income was down 4.9% due to slightly lower other income and financing charges. As a result, we therefore saw some pressure on net margin, which was at 3% in the first half of this year. Excluding this, we are seeing stability in our retail margins, especially compared to 2013, where we felt the impact of increasing industry competitive dynamics. We hope that we are seeing stability in the retail sector. Our main area of focus continues to be expanding our footprint to create and capture the under-penetrated organized retail sector. Today, we have a footprint of 249 retail stores across several different formats. In the last 12 months, we have added 20 stores, primarily in Save More, our smaller supermarket format that we are using to expand into rural areas and to gain greater neighborhood penetration in urban areas to grow our market share. And our total selling area stands at over 1 million square meters. Turning to banking, BDO had strong underlying results in the first half, and their headline results showed 22% decline in net income to 11.1 billion, but were impacted by the base effect of non-recurring gains from the trading last year. Excluding this, BDO delivered 19% growth in core income. This was driven by 24% growth in net interest income to 24.7 billion, which is the main driver of earnings. BDO's summary financials for the quarter show 27% growth in assets versus the same period last year, and strong loan growth of 21% and deposit growth of 35%. Net interest margins slightly tightened but remained above 3%, and the return on equity was at 13.3%. The bank's loans to deposit ratio stood at 71%, and gross NPLs lower than the previous period at 1.6%. BDO also maintained its strong capital position with total capital adequacy ratio of 14.5% and Tier 1 ratio of 13.5%, both well above regulatory requirements. Looking at the second bank in our portfolio, China Bank. The bank delivered strong net interest growth of 53% to 6.8 billion in the first half due to strong growth in its core businesses. Net income showed 25.5% decline to 2.2 billion, which, as with BDO, was largely due to the base effect of strong non-recurring trading gains in the first half of last year. Excluding this one-off trading gains, operating income grew strongly by 43%. China Bank's result for the first half year show over 32% growth in assets versus the same period last year, and this was boosted by both branch network expansion and by the acquisition of the Planters Bank. Loan growth was strong at 42%, as was deposit growth at 33.6%. And net interest margins improved on 2013 to 3.2%. Return on equity was at 9.1%, and the ROE figure includes the impact of the bank's 8 billion of stock rights offering in May. China Bank's loans to deposit ratio increased to 68% during the period, and the gross NPLs were slightly above 3%. And China Bank has a strong capital position with total capital adequacy ratio of 16.2% and Tier 1 ratio at 14.8%, also both well above regulatory requirements. Turning to our property group, SM Prime is in its first year of consolidation and reported first half results on a consolidated basis. It is already realizing synergies in planning future developments and accessing capital markets. At the SM Prime Holdings level, revenue grew 7.2% versus the first half last year to 33.4 billion, and net income was up strongly by 12% to 9.8 billion. Looking at SM Prime's component businesses, the malls continue to be the largest contributor with 61% of assets, 57% of revenues, and 66% of net income. Residential property, including the now wholly owned and delisted SMDC, is the second largest part with 27% of assets, 34% of revenues, and 28% of net income. Commercial, hotels and conventions, and leisure businesses comprise the remainder. In the first half across these business units, rental revenue comprised 53% of consolidated revenues, and it grew 12.5%. SM Prime has a strong balance sheet with net debt to equity ratio of 35/65 as of the end of June. And the property group plans to spend 60.9 billion in capex this year to grow all its business units. The bulk of this, 50%, will go to mall construction in the Philippines and in China, with residential accounting for 40% and commercial and hotels comprise 5% each. SM Prime recently announced their 5-year roadmap for expansion, which is detailed here. They plan to double the size of the business over the next 5 years, and this involves growing the malls from 53 today to 85 by 2018. Together with launching of an extra 20 residential projects from 21 today, tripling the GFA of office space through the addition of another 4 buildings, and adding more hotels and leisure projects. As a benefit of the merger, SM Prime also intends to focus on large-scale integrated master plan projects in the future, mirroring the success of developments such as the Mall of Asia complex in Manila Bay. Consolidated mall revenues grew by 14.9% to 19 billion, and excluding new malls, same-store rental growth remained at a healthy 7%, while net income grew by 16.8% to 6.7 billion. The Philippine mall performance showed 14% revenue growth to 17.2% and 10% growth in net income to 6 billion. Net margin remains healthy at 35%, and current occupancy across our 49 Philippines malls stands at 97%. Going forward, we expect our malls to continue to act as an anchor in our lifestyle city developments and to provide strong synergies with our retail businesses. And we expect our malls to continue to contribute over half of the revenue and net income of SM Prime. Looking at our Philippine mall network this year, we plan to expand gross floor area by 6%, adding 370,000 square meters to 6.6 million square meters. This will come from 2 new malls in Kawayan and Angono, and the expansion of 2 regional malls in Bacolod and Lipa. Plus, with the recently opened new fashion wing, the Mega Mall became the largest mall with a total GFA of 506,000 square meters earlier this year. Our China malls continue to grow successfully. The strength of our business model there is resulting in strong revenue growth and high profitability. The 5 malls delivered revenue growth of 29% and on high net margins at 37% in the first half of this year. Our success in China comes from our overall approach leveraging what we have developed in the Philippines. We are a mall operator who designs and builds our malls for our own long-term management using the expertise that we have developed in the Philippines. We also locate our malls in second and third tier cities where they can act as catalysts for growth and in which we participate as they grow. Accordingly, we are expanding in China by 1 mall this year in Zibo in Shandong province, which will have a GFA of 155,000 square meters. And we are constructing our very large 540,000 square meter mall in Tianjin, which will be opening next year. By the end of 2015, SM Prime will have approximately 1.5 million square meters of GFA in China. Our residential condominium business under SMDC delivered total revenues of 11 billion in the first half and net income of 2.7 billion. These numbers were down slightly, mainly due to the launches, which are more back-weighted this year. SMDC sees sustained growth in 2014 from its current condominium developments and the projects already in its pipeline. SMDC today has 16 ongoing projects, predominantly in Metro Manila, with 6 launched in 2013. It is worth mentioning that gross profit margin in residential was at 43% in the first half, compared to 39% last year. To date, our residential business has completed 5 projects and has 16 ongoing projects. These have delivered almost 64,000 units, of which 77% have been sold. And 6 projects are planned for launch in the second half of this year. In 2014, CapEx for SMDC is 18.2 billion pesos, of which 70% is for projects and the balance to add to the existing 147 hectares of land bank. In the current half year, commercial properties showed continued strong growth but reported only slight increases in revenues. Net income slightly decreased due to the elimination of intercompany rentals within SM Prime. As outlined earlier, SM Prime is increasing the rate of development of commercial buildings going forward, primarily in the e-com centers located in the Mall of Asia. With the development of 5 e-com currently under construction, SM Prime will have just under 300,000 square meters of office space by the end of this year. In total, the group plans to spend 71 billion of capex this year. Of this bulk, 61 billion is for property, as outlined earlier. In addition, the banks will spend approximately 4 billion primarily on branch network and expansion of IT. And the retail business will spend 4.5 billion on renovations and expanding our retail store footprint. Finally, key messages from our first half performance. SMIC is delivering strong underlying growth while strengthening the long-term positions of its 3 core businesses. In banking, BDO is driving profitability while maintaining a strong capital base. In property, SM Prime continues to deliver steady growth with the merger completed and has a 5-year plan in place to double the size of the business by 2018. And in retail, we are delivering resilient performance with aggressive growth plans in place that are based on our competitive strengths. Thank you very much.
I think we're ready to move straight to Q&A at this point. So can I ask people to please let us know which institution you represent and your name before asking your question? And there are microphones here at the front and halfway down the aisle. The panel, I think, is ready to take any questions that you might have about the results we've just given.
My name is Ron Rodrigo from Maybank, ATR Kimeng. We just wanted to have a feel of the recovery, especially for the residential segment for SMDC. And second question is that given that the GPM has improved, may we know, was it this because of the pricing, or I mean, sorry, the cost, or because of more revenue coming in?
As you can see from the results in the second quarter, there has been a pickup in terms of residential units that were sold, no? And we expect this to actually continue in the second half because we will be launching additional 6 towers of about 11,000 units that are strategically located in Metro Manila. So we expect that for the second half, we should be hitting on an average about 3 billion of sales monthly. Okay. On the cost side, we've been actually reviewing the cost structure over the last 8 months now, and we've tried to save on certain expenses, particularly on marketing expenses. In the past, you can see that in EDSA, almost all the buses actually carry the SMDC, ads, right? We've taken a lot of that because we have already set up a lot of the SMDC buildings, and we're using them to actually put signages to market the products of SMDC. Of course, on top of that, we've been looking at how we can improve the margin in terms of re-engineering on the construction side, and also in terms of support services to customers to minimize complaints, and therefore, we're able to save on the long term.
Thank you. Further questions?
Business is poised to register steady growth that will double the size of the business in 5 years or by 2018. When you say double the size of the business by 2018, are you referring to the sales, or that also includes the profit from the property development?
Yeah, that actually includes the income also. Yeah.
So double sales
Yeah.
and profit of the
Property group.
property group,
Yeah, yeah.
excluding the mall, right?
Sorry?
That excludes the mall.
Includes the mall, including the mall. Yeah, because the property group now includes the shopping malls, the residential, commercial.
It refers to SM Prime. basically.
Yes, SM Prime.
Double sales and profit
Yes,
in
yes.
5 years.
Hi, Doris Dumla from the Philippine Daily Inquirer. On SM Retail, could you discuss the trends in margins for the first and second quarter? Because the disclosure just said that the margin stabilized in the second quarter. And what's your expectation for the second semester for both food and non-food retail?
Yeah, we expect to recover by the third and the fourth quarter. We see a very artificial or temporary, say, shortfall in terms of profit, simply because of the new stores that we opened, and then due to that we had to incur more operating expenses, which is roughly about 1.7 billion. But we have already forecasted that for the third and fourth quarter, that we will end the year by more than 10% in income.
How much is the margin? Net
It's
margin
roughly
for-
24%. Yeah, that's the average both for the food and the non-food gross.
About the same store sales growth, it was 4.4% in the first half.
Yes, it's 4.4%. But combined, for both for the food and non-food, sales growth for the first half is 9%.
Good afternoon, Sir. Jerome Morales from Philippine Star. Sir, I would just like to get updates on your profit outlook for the rest of the year, because last time we had a briefing, you mentioned that depending on the banks, it would be still in the positive territory, but lower single digit. But in the first half, you already almost recovered from the first quarter. So what can we expect for the rest of the year and the full year outlook? Thank you.
I think in the first half of the year, the first quarter of the year, we mentioned about the budget will be about lower than the it's a single digit increase in income overall, and I think that budget has not changed, no? And delivery, you can judge by the delivery of our first and second quarter, no?
Question.
Yeah, Jeanette Yutan from JP Morgan. I have some questions on the retail. Can you give us the same-store sales growth for food and non-food, and what's your outlook in the next 12 months? How do you see the competitive intensity affect your company? And also, could you give us color in terms of your GP margin and EBIT margin trend? Was the net income drop driven mainly by a drop in EBIT or GP margin?
Those are what, 3 questions, huh? 3, 4 questions. Same-store sales were quite satisfactory. We're above inflation. Inflation is 4.9 more or less. We're about 5 point plus. And we're satisfied. That goes for all 3 brands: supermarket, hypermarket, and Save More. But that's a general average, so we're satisfied. And we think we can maintain our same-store growth as we go to the second half. Your second question was?
In terms of the net income drop, was it driven mainly by a erosion of your GP margin or EBIT margin, or both? I mean, could you give us more color on the net income contraction?
As Mr. Menjola mentioned, we invested in the opening of new stores, so that affects our OPEX. So yeah.
GP was not affected, did not deteriorate?
No, it did not. Yeah.
And then on your target of new stores, could you give us an idea what's your target for the year? And do you have a sense of the geographic targets in terms of the new store rollout?
For new stores, we still intend to finish with at least 20 stores, and this is primarily driven by Save More. We have opened several already during the first half, and during the months of August, September, October, there will be several more Save Mores coming on stream. Perhaps we should also add that we are also very busy with the renovation, which is equally important to the opening of new stores. And the renovation has also driven our same-store sales to a very appreciative levels. Yeah.
For going back to the new store
Yes.
expenses, is it because you bought the store, or is it primarily because of higher pre-opening expenses?
It's a combination of both. But mind you, our new stores are at this point all organic.
Okay. And then last question, could you give us color in terms of your venture with Alphamart? What's the strategy here, and how does this fit into the SM Retail Group? Thank you.
Alphamart, we're still with Alphamart on a very experimental basis. We're trying to find out how the relationship will be and what the effect of this venture will be on our other businesses. Yeah.
Hi, Igo Gonzalez from CLSA. On SM Prime, just wondering how were your pre-sales in terms of units and value for the first half and the second quarter?
Well, actually, most of the sales that we have generated in the second quarter, which averages about 3.1, 3.2 billion pesos, are actually coming from recently launched towers, no? Like we have Shore Residences at the Mall of Asia complex, where we continue to generate, like last month, we sold about 700 million worth. And these are still pre-selling stage. No? So majority of these are actually on towers that have just been recently launched. On the RFO side, we still have about 2,000 units, and we have created a new group, the RFO group, and they are able to actually start selling these units already, although it's not like major part of that 3 billion yet.
In terms of launches, how many projects have you launched so far year to date?
Meaning year to date?
Yes.
I think we have about 22 projects. January to June, we did not launch any this year. We're launching in the second half 6 towers, totaling about 11,000 units. Yes.
Hi, Gio De La Rosa from Deutsche Regis. I just want to ask for the SM retail numbers, is it accurate to say that the Walter Mart numbers were not full 6 months last year versus full six months in 2014?
It is the full 6 months of this year.
For both years?
Yes.
For 2013 and 2014, 6 months. Okay, thank you.
Are there any questions for the representatives from our two banks here, for BDO or China Bank? China Bank released results this morning, I think, so.
Hi, I'm Fred Chua from Abacus Securities. I'd just like to ask for SM Retail, what's the ratio between the food and the non-food in terms of probably revenues or net income?
You don't want to take that one.
In terms of revenues, it's about, I'd say, 65-35, 65 for the non-food, and 65 for the food and 35% for the non-food.
Ask for the bank. China Bank, could you give us an update of your acquisition or merger of Prudential? Is that the Planters Bank? Planters.
I would have to clarify first which media organization Mr. Joe belongs to. We did have a briefing for the combined integration team of the Savings Bank and Planters Bank to our China Bank board yesterday. They are on track to do the formal integration merger around November this year, along the guidelines set by the Monetary Board as a condition for the approval of the acquisition and approval of the merger. Meaning the branches to be integrated, to be relocated have been identified. The key people on both sides who will head which units have also been identified. And also whether the reorganizations, the realignment of the organizational units across the two banks to where they will end up in the merged bank.
How many branches will that added to China Bank?
Well, Planters Bank has 78 branches. So that's going to be a good addition to us. We are, in our initial plan, our initial 5-year plan called for just 400 branches by 2014. So we will have exceeded that already on a combined basis for. So just to clarify, the numbers that you saw is that the 2030 numbers did not include the Planters Bank yet. The June 2014 numbers include that because the formal approval of the BSP Monetary Board of the acquisition was happened in May 15. So that's the full consolidation of these numbers for Planters Bank is effective this reporting period of June 2014.
The central bank recently raised overnight rates by 25 basis points. So that would, in fact, be beneficial for banks because we can reprice our loan assets 30 to 90 days, while we have the CASA, or these are the current account, savings account, low-cost deposits that have a fixed rate. So in a way, this would be repricing on our way up, and that should help support our margins going forward. In fact, for the second quarter, we already saw a 6 basis points improvement in our net interest margin on improving asset yield and managed funding costs.
Sir, good afternoon. Roel Castro Malaya. Phone question. Had there been a change now in the leadership of China Bank?
Was that the leadership of China Bank? Yeah.
Well, the only thing I can confirm is that there's a disclosure where the board yesterday noted that our president and CEO is retiring as president by August 31. But he will hold on to that position, of course, until his replacement is named. He will, of course, remain as a director of China Bank.
What has been the impact on the malls and the retail businesses, and including the malls tenants? Are we gonna see an effect on sales or earnings for the third quarter?
No. There's no effect in terms of sales. In terms of assets, the only major damage was in our Taal Vista Hotel. That's the only one. All the malls are okay. Although we had some malls during the typhoon that we had to open like towards the afternoon. But we do not expect any impact in terms of sales. In fact, I was with Robinsons yesterday with one of their officers, and they were saying that during that time they had no electricity, and I think their genset didn't work. So they said that a lot of people actually moved to Mega Mall.
Slight uptick in sales for emergency goods in the areas which were hit by the typhoon, but otherwise our stores were all safe, and some of them were even used as temporary shelters for those that were affected by the typhoon.
Can you give us your details on the capex on the SM Group?
CapEx for the SM Group, we actually had a slide on that. Yeah, 4.5 from retail, 4 from banks, and 61 from property, where 30 of that is coming from the malls and 24.5 is residential.
Right now, the groups that are fast expanding rapidly is SM, then we have Robinsons, and then Pure Gold. But there are new entrants. I'm wondering, what's your take on the new entrants outside of the three groups? Are they expanding fast enough to be a threat to any of the three, or they're not showing signs that they will actually be a threat to the top three retail groups?
When it comes to competition, we do recognize competition. We always watch them, and hopefully we can outrun them. But basically, whether it's a small group or somebody who's coming in just new, we really have to watch and we have to try. We have to work harder.
Yeah. Could you update us on the discussions with Alphamart and your entry into the new retailing format?
You were asking Alphamart? We're still on an experimental stage with them. We have 3 stores so far. And we're studying the impact, as I said, on the community, on our other stores, on whether or not we have the competency to do the business. Yeah. Yes.
Where?
The 3 stores are in Trece Martires, Dasmariñas, Cavite, and one in Las Piñas.
The plan is to have 10 stores by end 2014. Are you on the same page on this one?
Yeah. But again, as I said, the whole thing is exploratory and experimental, and yeah, we have a very strong coordination with them.
And follow up. In this venture, you will have control, or it will be?
That is also one of the things we're exploring at this point. Yes, sir.
Mark Reyes now, BPI Securities. Just wanted to ask, based on your capex of 71 billion for the entire year of 2014, how much of that has already been used? And from the remaining capex for the second half, where will it go mainly?
For the first half, I think we actually spend about maybe 25-30% of the total amount. As I've discussed earlier, we're launching additional projects towards the end of the year. And out of the 61 billion that we're budgeting, about 12 billion of this will actually for land banking. So most of the land banks right now are in nego stage, and we expect this to be done before the end of the year.
If I ask the banks, any color on your capex to date versus the rest of the year?
Well, in our case, it's really almost equally divided between technology enhancements. We're in the final stages of cutting over to a new core banking system. We just went live with our new ATM platform, and the core banking system, of course, will happen in two major parts. One is both the China Bank and the China Bank savings in one go, and then after the system stabilizes in 3 to 6 months, then we will migrate the Planters Bank branches onto that new platform. The other half, of course, is related to the continued expansion of the branch network. So just to update related to Mr. Xiao's earlier question, as of June, we have 453 total branches, of which 299 is with China Bank, 76 with the Savings Bank, and 78 with Planters Bank.
For BDO, the capex is mainly for the branch expansion. So we are looking at 50 new branches per year. To date, we've opened around half of that already. And most of that really will be for accelerating our expansion in the provincial areas.
Thank you. Retail, I don't know if you have any color.
For retail, we've spent more than half of that, because and the remaining will be spent for the second half. We're on target, actually.
The experimental stores, the 3 experimental stores, how big are they, and they are operating 24 hours, and why these locations in particular?
The stores are on average 150 square meters. They're operating 24 hours. Why in that location? Cavite, that particular area in the south, you have high population density, you have traffic, you have a combination of rural and urban scenarios. So it's a good mix for us to find out if that particular format will work. Yeah. We invite you to go and visit those stores. We'll give you the exact addresses later.
And in case this experiment proves to be successful, do you have an idea how aggressive you want to roll out this new format in the next few years?
We will cross that bridge when we get there, Doris.
Sorry, what's the question? The question is, will they operate 24 hours?
It will, eventually, yeah. Yeah, it will eventually operate 24 hours.
There's clearly a lot of interest in this Alphamart relationship and the experiment going on, but I think what you're also hearing here is this is still at a fairly early stage, so there'll be a lot more information coming out of this perhaps later on once we've formalized the relationship and the business model.
Yeah. Hi again. Sorry. Just one last thing for the China operation for SM Prime. If you could give us a sense of, how's the operation now, and given that you'll be opening at least for next year Tianjin, it's I think the biggest in terms of your 5 existing malls. So, what will be your expectation there?
Well, for the first half, China is doing very well. In fact, the last mall that we opened in Chongqing, in terms of take-up, it's quite strong. And even the residential development that is within the shopping center area. There are a lot of concerns on the Tianjin opening next year. We're still working in terms of the tenants that will locate in this Tianjin mall. But the plan right now is that even if the size is 540,000, is that we will not actually open that one time. It will be in phases. So we'll probably start with about 120, 150,000 to make sure that we have high occupancy level when we launch and open that. Our experience is that if you start with a low occupancy level and for just the mall to open, it somehow struggles once it's open, meaning tenants coming in. But if we open like the one in Chongqing, where we open like 50-60%, getting tenants in after opening is a lot easier. So, and that's why for Tianjin, we will do it in phases. The China development, as we've always stated, is that it's really long-term growth path for SM Prime, and we will continue to be conservative by opening just one mall per year, probably in the next 3-4 more years, okay? Until we get to that level where we have the brand already, the brand equity, and then if we have the larger base of multinational tenants. That's one of the key to the success of the operation over the last 3 years, because the multinational brands started to go into the second-tier cities where our malls are, and when they go into that location, we're fortunate that we're always the top choice in terms of the multinationals locating. So even, I think you were the one who sent me that email, Ron, about competition in China, right? But even as there are competition coming in, because we're the first mover and we have the multinational tenants with us, Xiamen, for example, there is no question that the SM Mall has the largest, as the biggest crowd, and in terms of sales per square meter, has the highest among all mall operators in Xiamen. And we want to duplicate this in the other cities that we're in, and that's why we're not rushing, opening like 2 or 3 malls, because we need people to also run this business.
My question is actually on the impact of the logistical issues that we have right now with the international container ports. How has that affected your supply chain, and has that increased your, I guess, your storage costs, because as you will now have to carry more inventory in anticipation of any delays coming from I guess the deliveries from the trucks. No? So what is the impact so far as your I guess your supply chain is concerned?
Sorry, could you give your name and organization, please?
My name is Jomar Lacson. I'm with Campus Lanuza.
Well, for retail, definitely we have to order earlier, in preparation for the Christmas season. So our merchandising group has been ordering quite a lot now. And of course, that will probably increase our warehousing cost if the deliveries come earlier than we expect. Currently, we are not really that affected, but our suppliers, at least our concessionaires, because they're not able to bring out from the customs as fast as they can. So obviously the deliveries to the stores are affected. But some of them are saying that it's already being corrected, and hopefully within a month, they'll be able to correct it fully.
Food retail side, we are being given priority for supermarket, hypermarket, and Save More by our larger suppliers. Somewhat similar to department store or to dry goods, our SME suppliers are the ones that are getting affected, especially those who are dependent on a high degree of imported raw materials. So they're the ones whose service levels are, during the height of this problem, have suffered. But hopefully things will pan out well. But right now, we're managing our inventories well.
On the property side, hopefully, things will improve, or I think the government has seen that there's really a problem here. The thing for the property is that we have contractors that have imported like kitchen fixtures coming from China, and some of them are like delayed 2-3 months now. So it's good that these things are coming out so that improvement can be implemented soon, because if this will be prolonged, what will happen is that we might encounter certain issues in terms of turnover of units. But so far, things are still in control. Yeah.
Has like the supply of rebar, steel rebars, affected by this as well?
I think so. So far, we don't have any problems with our steel suppliers. But I think, again, as I've said, if this will continue, it can be a problem moving forward.
Okay. I guess my second question is actually on the, you mentioned on the CapEx, the land banking. What are you land banking for? Is it really for the malls as well? Or it's a, how would you distribute the land banking between the residential projects and the malls?
Combination. Because right now, since we consolidated the property arm of the SM Group, we look at land banking for certain locations for lifestyle cities, so big sizes. All of this will be under SM Prime. So you will have the malls, the residential component, and also the commercial property. But the residential side will also continue to look for land on a standalone basis, provided it's near the transport hub, no, or near our existing shopping malls. Just like the one that we had in North EDSA, where the mall has been there since the 80s, and SMDC was able to buy the property at the back of the mall. So we continue to scout and look for additional areas.
Okay. I also noticed on the, my last question on, I noticed that the capex for like office has not, well, it will be just 3 e-com. Does that reflect that you view that you're not going to invest so much in offices? So is that market weak for you guys, or
no?
You
In fact, the BPO sector is still very strong. We are actually, because we're opening, we're turning over the 5 e-com. That's the 3 e-com before. But we also have one in North EDSA, the Cyber West. That's in front. We will start the 3 e-com by early next year. And in some of the locations of the SMDC residential component, like the one in Pasong Tamo, we might convert some of that actually into BPO buildings instead of residential. So we're looking at the various sites that we have, and we will accelerate also the BPO developments, the buildings.
Okay, thank you.
Question at the front.
Congratulations on a good set of numbers. Gino from Macquarie. Just 2 questions. In China, do you see an opportunity for your successful lifestyle communities to also be part of what you intend for China, not just the malls? And the second question is, for the group, are you open to other sort of business lines or opportunities, be it infrastructure, energy, resources, or are you happy with what you have on the plate now? Thank you.
For the property group, in China, what we'll probably do is, beyond shopping center, we'll probably take on some residential developments in the future, right? So that instead of buying property only for the mall, we'll probably take extra and do residential. It cannot be like lifestyle cities that we have here, where you have the BPOs, the other like hotels. No, our plan right now in China is just to do malls and extend that at most to residential developments.
Strategic side, we're actually committed and will focus on our 3 main core businesses. But that doesn't stop us from entertaining some ideas when there are very good opportunities out there.
I just want to know, why was the growth in SM retail sales only 3% year-on-year in second quarter alone, when 1Q was up 16%, and considering that same-store sales growth is about 5%, as you mentioned, and there were new stores opened?
As you know, we have the 3-day sale event, no, which we hold twice a year for each store. And there was a shift, no, from the first quarter to the second quarter. So the ones that were holding it on the second quarter last year held it on the first quarter this year. So it's just a timing difference.
With that, thank you to the panelists, and thank you very much for all your questions. Thank you for your attendance.